Good afternoon. As I outlined in the weekend video update last weekend, it's now pretty obvious that our economy is in some degree of strife. And investors who just do the same old, probably because they don't know any other way, are highly likely to get a pretty meagre return. That looks to be very clear to me. Most people haven't saved enough to either just get a meagre return, or worse, if we do get more significant downside in the Australian economy, we could get equally downside in the Australian market. And most people just aren't in a position to have another 20% plus drawdown as well. And if they don't know what other avenues exist to get a good return, that return can make a significant difference while minimising downside risk. Now, I only do this type of video when I've got something really important to say. And this is the first one I've done in about 2 years, so this is something that I do very rarely. And my objective is twofold. The first is to give you a sense of a very productive way to go about investing. And the second is to provide enough confidence so that you're more likely to pull the trigger and not be put off by the short-term volatility, which I think is absolutely inevitable. So they're my objectives for producing this video. Now, my overriding theme when I do my research work is to enter when the upside appears to be significant and highly likely, and also while the short-term downside, if any occurs, is likely to be shallow and brief. Now, I don't always get it right, but that's the fundamental thrust of what I try to do. And if you bring that sort of process to the table and you get a healthy percentage of them right, then you end up doing pretty well. Now, at the moment, I'm seeing a number of really outstanding opportunities across many sectors of the Australian market. And so this video is about two of those, but it's just an example. These shouldn't be taken as specific recommendations, but rather an outline of a process that I find is extremely effective. So let's jump into it. So just to point out, there's my licensing details and the fact that this is general advice only. So this is not personal advice. And as I said earlier, it's really just an example to to get you to think, hopefully get some confidence about where to put your money in the Australian market. So looking at the Australian opportunities, and I covered this in the weekend video, and if you didn't see that, perhaps go back and take a look, because I don't want to recover that ground again. But the Australian economy is facing some significant difficulty, and that means that it makes it likely that many of the top 100 stocks are going to struggle to provide a worthwhile return. Those two things pretty much go together. So what are the sort of stocks in Australia that are highly likely to be major winners, even if our economy, stays where it is, or looks fairly likely, gets even worse, particularly as I don't think this housing downturn has anywhere near run its course and all the ramifications that come from that. So the sort of stocks that are highly likely to be major winners are those with a very large addressable market, but they're still small enough to have a really big runway for growth ahead of them. There's not a lot of, or there's not as much value into getting into something that's already overwhelmingly the major market leader, like let's say a Facebook or an Amazon. You're not going to make amazing returns from stocks like that because they already dominate their sector. So you want to get a stock that is profitable, the business is up and running, and they've got a very long runway for growth ahead of them. Secondly, and this is critical, you need outstanding management teams to capitalise on that opportunity. Thirdly, they should still be undervalued compared to their growth potential. And sometimes stocks tick these boxes, but they've already got a lot of that blue sky priced into them. And so you might be waiting for quite some time, and you might have to put up with some sort of drawdown first. So I'm looking for the ones that are undervalued compared to their growth potential. So the first one that I want to look at, and again, let me stress, these are not recommendations. These are just two examples. I believe they're extremely good examples, but they're really more about showing you the process. So a company called Aurelia Metals, the background on them, they're a gold and base metals producer, developer in Western New South Wales. Over the last 5 or 10 years, the US and Canadian major gold miners really stuffed it up big time. They overpaid at the top of the cycle, took on huge amounts of debt, and got themselves into a heck of a lot of trouble when the gold price turned down in 2011. And what that's allowed for several companies is the opportunity to pick up a really good asset that was underdeveloped for just a ridiculously meagre price. And certainly Aurelia Metals was able to do that in securing the Peak mine in Western New South Wales, which was a mine that had something like $500 million spent on it in development, and they bought it for $58 million and basically paid it off within 3 months from cash flow. So, it was a real company changer. I think we're also, particularly for Australian gold producers, are in a highly attractive environment for our local producers, because the Australian dollar gold price has gone up significantly. It's above $1,800 an ounce, and that means that our Australian producers have got extremely fat profit margins, even with the gold price where it is. Now, Northern Star has been a favourite of mine, and if you've followed any of my work over the last few years, you'll know that I have maintained that it's the best managed gold stock on the planet. And Aurelia Metals, the comparisons between the two companies is really quite remarkable. Now, Aurelia Metals is probably 5 years behind Northern Star in terms of where they are on their growth curve, but it really is amazing. So the Northern Star playbook was this: acquire a promising asset that hadn't been developed effectively and that was in the hands of a company that was in a distressed situation, so that you could buy it very cheaply. The second step is to build resources through exploration and create multiple growth opportunities. The third step is to diversify your mining risk. And the fourth step, and this is really important, is to continuously deliver to shareholders. In other words, under promise and over deliver. And Northern Star has done that wonderfully well. Aurelia Metals hasn't really got that track record yet, but they've certainly well on the way on the first 3 points. So let me jump in and take a look at Aurelia Metals. So I want to look at the fundamentals and also do a technical analysis as well. And this is the sort of thing that I do in Portfolio Analyst. So very clear similarities to Northern Star. Northern Star from 2011 to the current day has multiplied around about 30-fold in its market capitalisation. Now, I'm not suggesting that AMI is going to do the same thing, but at least it gives you an idea of the sort of potential when you get it right. The market cap of Aurelia Metals now is $800 million. They've got very, very healthy return on equities of close to 100%, and that's because they were able to buy this great asset for an absolute bargain basement price. Now, the earnings per share growth going into 2020 and beyond at the moment appears to be around the 40% per annum mark, so it's very healthy growth in earnings. They've already got significant free cash flow. They've got zero debt. They've got $108 million cash in the bank, and they've got two very high margin operations. So it's a very good story. Add to that the fact that they're absolutely bottom quartile gold producer because they get credits from the base metals that they produce. And in the last report, they're producing gold at a net $794 per ounce, which means that their profit margin, and that's all in sustaining cost. That's not just cost of operation. That's all the other things loaded in as well. So they've got an overall net margin in excess of $1,000 an ounce. Now, they produced 74,000 ounces in the first half, so it won't be too long. They'll be 200,000 ounce a year producer, and that's sort of that's a good first hurdle to get to. They've got a proven successful management team, and in the same vein that NST did, the guy who's now leading Aurelia Metals was also involved in the Peak Mine at an operational level, and so knows where all the good bits are, knows where the good deposits are, knows where to focus the exploration effort. And so far they've done it very well. Now the current PE is a very low 9 times, and that's very, very cheap, but it's mainly because the current mine life at the moment is only 4 years. But they know that they've got a lot of exploration potential, and already the exploration is producing some very promising results. Now, in the case of Aurelia Metals, the market cap in 2017, before it bought that Peak Mine, was $100 million, and now it's $800 million. So the market cap here has already gone up 8-fold in the last bit over year and a half. So they're already on a strong growth path, and you can see from the chart here that it's a very, very nice uptrend that's in progress. Now, I'll just touch on the risks. Obviously, commodity prices are always a risk with a mining operation, but in the case of Aurelia, that is partially alleviated by the fact that they've got a very low cost of production, which means that they're going to be making extremely healthy profits even if the gold price does fall. And they're also on a low PE, so it's not like this upside is already priced in. So those things tend to offset the commodity price risk. Now there's operational price risk, but they're spread across 2 and possibly in coming years 3 or 4 operating centres. Currency obviously is a risk because of the fluctuations in the US dollar and how it affects the gold price, and exploration risk as well. And this, the progression of this company will depend on them finding and being able to develop more gold. So there's no question about that. However, that's why it's only on a market cap of $800 million, where Northern Star is on a market cap of about 6 times that. So there's still plenty of room for this to grow. Let me just go to a cleaner chart and just look at the technical side of things. So from a fundamentals point of view, it would appear that there's extremely limited downside from a fundamental and valuation point of view. However, that doesn't mean that the share price can't fall, because often prices go in a different direction to the fundamentals. So we look at the price chart. We had a peak here in 2011. That was the peak in the gold price, and that was at around about 80 cents. We then had a massive pullback. The stock got down to 2 cents, but as you can see, has now gone back up and is getting close to $1. So we ran up to resistance, we paused, had a bit of a pullback over a period of a few months, and you can see then we've broken out very steeply. So it was only on the 9th of January, this was trading at 66 cents, and today it closed at 94 cents. So it's been a very, very strong run. So if we look at this technically, and I'll just get rid of this big volume peak over here, so you can see we had really strong volumes leading up to the pause. We then went sideways, very shallow pullback on quite low volumes. So that's indicating that there hasn't bought any selling out of the woodwork. So we'd gone up to a major resistance point, but the sellers didn't really appear. We got a zone of very quiet trading, which indicates that you're generally getting close to a move higher, a renewal of the uptrend. And you can see here, then the volumes started to lift again as the price went up. We had a little look over resistance, paused for another week or so, and then we've taken off. And you can see on today, which is Monday the 11th, you can see the price appears to be on the move again, and very, very large volume today. So this fits the bill for me. Mining stocks don't suit everybody, but it certainly meets the main criteria that I look for. Now, the second stock I want to look at is EML Payments. So let's just have a look at the background on EML Payment Technology. The background, they're a global payments processing platform that operates across Europe, North America and Australia. They're very much a beneficiary of the global trend away from cash, cheques and credit cards into electronic payments and debit cards. And, you must see that every day around you. It just gets bigger and bigger, that theme. And I think that's an absolutely unstoppable theme for the future and is completely independent of what happens to the global economy. The key attributes of this stock, management has got plenty of skin in the game, which is always good to see. The contracts that they strike with their clients are struck on a long-term basis, 5 years and beyond. I love this. 90% of revenues are recurring, and it's very costly for their clients to actually change away from this relationship. So that means that they're very sticky. So that's a bit of background. Let's take a look at the actual fundamentals. So this one's a bit smaller, market cap 430 million, but it's still got some size. Return on equity is only 8%, and that's lower than I would normally look for. I normally look for return on equities of 15% and above, but return on equity is rising very quickly as they reach, or they've now reached profitability and starting to really expand. So I'm comfortable with that. Their EBITDA margins are currently 30%, and the company expects those profit margins to rise to around 40% within the next year or two. The balance sheet is in great condition. They've got no debt, and they've got $50 million in cash with a projection that should reach $60 million by June. Now, the 2019 PE is 34 times, which is not all that cheap, but the earnings growth rate is substantial enough to make that reasonable value. But the market is really starting to price in where this stock will be, or where the earnings will be in 2020. And that drops considerably to 20 times. So it's a really substantial growth in earnings from this year into next year. So I'm comfortable that this still represents very good value. So the company has an enormous runway for growth ahead of it. I don't believe very much of that has been priced in. So from a fundamental and valuation point of view, I think there's limited downside. Just some other comment. The primary future growth drivers for this stock is really gaming activities in Europe and America, which are obviously expanding and substantial. And I might also add that 80% of their revenue is offshore, and therefore a lower Australian dollar, which is certainly the trend at the moment, is an advantage to the company. So let's jump in and look at the technical picture. So I'm looking here initially on a weekly chart. So you can see the market definitely got ahead of itself. Here we had a very, very sharp run up in October of 2016. We got a bit of a pullback, went up, formed a double top, and then we got some selling. So this was really a point where the stock had definitely got ahead of itself and needed to do some sort of consolidation. And given the massive rise that we'd had, where the stock price had gone from under 10 cents to $2 in the space of, that was November 2012 to September 2017. So it had gone up an awful long way in the previous 5 years. So it's not unreasonable to expect the consolidation to take a little bit of time as well. So we really got deviated well above the mean. We did get some selling off the peak, and then we got some significant follow-up selling here, which occurred in March of 2018. So that brought us down to a low point, which looks like it is now the low point for the cycle. The stock moved up, not on particularly large volume. We got a pullback to a higher low, I should say. And then you could just see in the last 2 weeks, you can see the price has really started to move strongly again. And so we formed a base around about the 140 mark, and now quite clearly we're getting some strength in the upward trend. Let's look at the daily chart, and you can see that that we've had some pretty good volumes being sustained down here. We got a little bit of a pause today, Monday the 11th, but you can see the volume is absolutely tiny. So this looks very robust from a technical point of view as well. From a tactics point of view, given that it's just moved up from 140 to 170, I think you've probably got two options: either wait and try and buy it at around 160, or alternatively take a partial position now at 170 and then try and add some more on a bit of weakness. So that there's a couple of examples of the process that I apply both fundamentally and technically. Now, this is what I do just week in, week out in Portfolio Analyst. This is just stock standard stuff. And Portfolio Analyst this week, I'll typically be covering between 8 and 15 stocks. That's typically what I cover each week. They're in response to questions from members. So we've got a lot of eyeballs on the market, and I get a lot of very good questions, and stocks get raised that I was not aware of. But I also inject some recommendations of my own, and of course the all-important tactics and perspective on the market. So what you'll find in Portfolio Analyst, if you're not a member and you haven't tried it yet, is that there's training, there's lots of analysis like you've just seen, there's tactics, there's recommendations, and there's the benefit of lots of members finding opportunities. So if you want more, I hope this video has been of help to you, and I hope it gives you confidence to stick with it in the Australian market, because there are great opportunities. It's just hardly any of them are in the top 100. So if you want more than what's in this video, it's available. I can provide that. There's a $1 trial available on Portfolio Analyst, and I hope to be able to assist you in the market in coming years. So that's it for now. Cheers.